We have Mr. Rahul Bajoria, the head of India and ASEAN Economic Research, Bank of America Global Research, joining us on the show. Rahul, hi, and thanks for your time. Lots of talking points. In your report, you've said that GDP growth is likely to be stronger in FY26 than we had previously anticipated. And on the back of that, you've raised your GDP estimate for FY26, and you've also modestly upgraded FY27 GDP estimate as well to 6.8 from your 6.5% projection earlier. What's driving this confidence, Rahul? Talk to us about the underlying factors that you're watching out for in the macroeconomy right now.
A very happy new year. So I would say essentially it's an acknowledgement that the data cycle, particularly since the GST cuts have been undertaken, has been fairly strong and quite broad-based in the way it's been playing out. So we have seen a variety of indicators, whether it is car sales, whether it is credit growth numbers, whether it is fuel consumption, even mobility indicators. They are all starting to show a fair amount of positive momentum, both sequentially and relative to where we were a year back. And at the same time, the policy bias obviously remains relatively positive in the sense that it remains a source of support, with the RBI restarting its rate cutting cycle, doing a ton of liquidity injections, and then fiscal policy also playing its part. So I think all put together, this essentially would reflect in a higher real growth environment. What we have maintained is the fact that there will be a modest slowdown from the current fiscal year to the next fiscal year, which will partly be a reflection of the tax cuts phasing out to a certain extent. But then we are also anticipating the effects of the trade impasse between India and US to sort of start feeding into the trade numbers as well, which will be a bit of a drag.
Hi Rahul, this is Harsh here. Rahul, talk to us about what within the Indian economy are you most bullish about in terms of growth? Credit indicators have started to see an uptick, so we're starting to see good growth numbers clocked by the financials. Talk to us about the pockets which will likely outperform or contribute to this growth, or this increased growth, if I can call it, that you are calling.
So Harsh, what we are essentially seeing is that consumption has continued to outstrip investment growth, through 2025, and my sense is that this trend will continue to a certain extent in 2026 as well. Now, one of the biggest challenges that we saw in the last couple of years was the slowdown in the nominal GDP growth side, but that also is likely to make a modest recovery in 2026, which should feed into urban incomes and in return also sort of help with discretionary consumption cycle, which we are seeing signs of strength in already. The other factor that we think will remain relatively supportive is the fact that government capex, after a period of relatively modest growth in 2024, in early 25, has made a very strong comeback. And I think with the project pipeline being relatively strong, you will see even if private capex remains relatively sluggish, public capex is going to remain more focused on execution and on implementation, which will provide a fair amount of support. This is visible in indicators around construction sector. This is also visible in our steel demand, in demand for land, etc. So we think that both these pillars are likely to remain quite supportive of the economy into 2026. Our sense is that the credit indicators, etc., also will provide a bit of a fillip, but they are going to grow within a certain limit. They will not have unlimited growth in some ways.
Okay, Rahul, appreciate that view, and thank you so much for your time today. On that note, we'll let you go.